Okay, let's dive into Ferguson. The company just dropped its first quarter numbers, and honestly, on the surface, they looked pretty good. But the market's reaction? Whoa, it was immediate and it was brutal. The stock took a 7.7% nosedive. So in this explainer, we're going to break down exactly why such a solid report led to such a massive sell-off. And this right here is the puzzle we're unpacking today. On one side, you have a revenue beat, you've got an impressive 16% jump in adjusted earnings per share, and management is actually raising their outlook for the whole year. I mean, that's the bull case, right? But then, on the other side, the market delivers its verdict, the stock's worst single day in months. So what did investors see that the headlines completely missed? So what in the world happened? Let's get right into the headline numbers that created all this confusion and figure out where the whole narrative really broke down. Okay, so revenue came in about at $8.2 billion, a little bit ahead. But the real drama, the real story, was all about earnings per share. Now, this is where it gets really interesting, because this slide shows you why everyone was so confused. Ferguson reported what's called adjusted EPS, that's earnings with some of the one-off stuff taken out, of $2.84. Now, if you are following some analysts, that was a solid beat. But the widely followed Refinitiv consensus number was higher, around $2.97. And the market? Well, it latched onto that number, and just like that, the quarter was framed as a clear miss. Now, let's dig a little deeper, because once you peel back those headline numbers, you find a company that's living in two completely different worlds at the very same time. And wow, this chart just perfectly illustrates that split. The company's strength was incredibly concentrated in its non-residential businesses. You've got commercial mechanical up a massive 21%, and waterworks grew a really strong 14%. But all that strength was basically hiding some serious weakness in the residential parts of the business, where HVAC revenue actually fell by 6%. So the key takeaway here is that this non-residential boom is being fueled by what Ferguson calls large capital projects. We're talking massive builds for data centers, pharmaceuticals, and high-tech manufacturing. And get this, management confirmed on their call that data centers alone now make up over half of this booming category. That's a huge deal. And you know, it wasn't just about the top line. Operationally, this company is executing almost perfectly. Gross margins went up, adjusted operating margins jumped, they generated strong free cash flow, $325 million. They even returned $372 million to shareholders. I mean, you look at these numbers and you think this company is firing on all cylinders, which again makes that huge stock drop so fascinating. So with this mixed picture, you've got strong non-residential, weak residential. What did management have to say about the road ahead? What are they signaling? Well, here's the twist. They actually raised their guidance for the full year. They're now expecting sales growth of about 5%, and they even bumped up their margin outlook. I mean, that signals some pretty clear confidence in their ability to deliver for the full year. The CEO, Kevin Murphy, his tone on the call was what I describe as cautiously bullish. You know, he admitted things are challenging, but he kept hammering home their strong execution and their confidence in the medium term. All good signs. But, and this is a huge but, the real story, the thing that was the actual catalyst for the sell-off, it didn't come from their prepared remarks. It came out during the Q&A session. It wasn't about the full year. It was all about the next 3 months. On that call, management guided for a pretty significant slowdown in the current quarter. They said growth is expected to drop to just 3%. Now, that is a sharp drop from the 5.1% they just put up. And what that did was confirm that the problems in residential and HVAC, they're not getting better. In fact, they're going to drag on results into next year. For a stock that was priced for perfection, that was the only data point that mattered. So, after putting all the pieces together, what's our call on Ferguson from here? Well, it's time for the next call. The bull case is still really clear, right? This is a best-in-class company with huge tailwinds from things like data centers and fantastic operational discipline. But the bear case, which definitely won the day, it zeroed in on that cyclical weakness, the slowing growth right now, and a valuation that just had zero room for any bad news. So here's how we think this is going to play out. First, we're predicting that the next quarter's results will come in right around that 3% growth number they guided to, showing that continued slowdown. And second, we expect the stock to kind of trade sideways in this new lower range as the market just digests these reset expectations and waits for something new to happen. And that brings us to our official rating, market perform. Look, Ferguson is an excellent company, but after a 40% run-up year-to-date, the stock was simply priced for perfection. That 8% drop wasn't really a panic. It was a necessary valuation reset. From where it is now, we see a much more balanced risk-reward profile.
This is not financial advice.